Good afternoon and welcome to the Wall Street Crossover Show, sponsored by Admiral Markets and with their market commentator, Darren Sinden.
Good afternoon, Zach.
A name that nobody can forget.
No, indeed, sir. Thank you.
Right. Very busy day today. Not like the middle of summer, but actually like sort of sometime in the autumn.
Yeah, I mean, it's a proper day, plenty to get our teeth into. But before we start, if I may today, I'll just come back to a question that Nick asked me yesterday, which was, what did I think about the breadth in the S&P and the possibility of a correction back to 1970, which is flagged by an analyst at Oppenheimer. So I've had a look and just tried to look at it from a slightly different angle. So I've plotted the NYSE cumulative weekly advanced decline, i.e. the net total of stocks that advanced in stocks are declining over the S&P. And from what I can see, there's really big divergence and not something that we've seen in recent history, certainly not on the chart packaging that I've got. So that is something of a worry, in as much as the S&P is carrying on and the advanced decline line is moving sharply lower. I also note that in my point and figure model, the S&P will break back to bear trend at 2060. That coincides pretty much with the 200-day exponential moving average. And just from an anecdotal point of view, the S&P rarely does well if it breaks properly below that 200-day EMA line. The last time it did so was in October last year, when we had that mini flash crash, albeit only lasted for about a day and a half. Nonetheless, it was a significant sell-off. So the prospects for a correction, in what I understand, historically is the weakest performing quarter of the year. I would say, it's a genuine possibility we could do that. Yeah.
Isn't the other point, which is an obvious point, really, to make, that even if nothing happens, the market is extremely confused. And there's a massive sort of split down the middle in terms of people who are very bullish or remain bullish and people who are very bearish. And that's something which doesn't normally happen very often, and also doesn't normally end in a happy way.
No, markets hate uncertainty. They like a balance of opinion in one direction or the other, and they like to be able to plan ahead. As you say, there are a wild range of inputs at the moment, and it is very difficult to see a clear path. And in those circumstances, then the risk must always be to the downside. Yeah.
Right, okay, well let's move on to the normal part of the Wall Street Crossover Show, which is the data from the European session.
Okay, well, first thing we'll do is look at something that happened in Asia this morning, but China devalued the yuan by 1.9% versus the US dollar. That's the largest devaluation in modern times by the People's Bank of China. Some have seen it as a move to try and shore up a failing economy. Others are trying to put a more positive spin on it, saying that it's a move towards getting the yuan into some kind of shape to be floated and then perhaps raised
a normal currency.
Raised up to a normal currency, but for the Chinese to become a reserve currency, with a view ultimately, I guess, to taking over from the dollar. Anyway, remains to be seen why they've done that. I'll keep my cynic's hat on and suggest it's more about the economy than it is about trying to
join the big league.
Yeah, although those two things could go hand in hand. So that was the first news. And
has the market taken that, in general, people have taken that bad, not well, let's say?
No, they haven't. They've erred on the side of caution. They've assumed that it's because the powers that be in China can see the economy failing, or at least failing to grow, and maybe not even maintaining this sort of 6.5%. Growth benchmark that I think we all realistically think is the reality at the moment, and maybe trying to head off further issues with liquidity and credit squeezes elsewhere. So no, negative for now, but as people look through it, maybe they'll change their opinions on that. I'm not going to, however. And then in terms of other news, the Greeks and creditors are said to have agreed terms for a third bailout of somewhere of the region of 86 billion euros. No details as yet, and oddly enough, the news broke in a tweet from one of the Greek politicians. It seems a strange way to announce that kind of momentous news.
Really gives the impression of a sticking plaster type of event.
Yeah, absolutely. My thoughts here. Borrowing more money isn't likely to.
And the other point, actually, which is amazing, is the way that really the China news overshadowed the Greek news.
Yes, because I think probably the market's of the opinion that a deal will be done over Greece in the not too distant future, but it will just, as you say, be a sticking plaster over a major wound, and it just kicks the can down the road to the next time they're in trouble, which could be anywhere between a year and 18 months, I guess. Speaking
of trouble, the ZEW survey?
Well, yeah, slightly baffled by the differential between the two, but the figures are for August. It's first of all economic sentiment, and a sharp drop to 25, well below the forecast of 32, and the prior read of 29.7. So those in the German markets are not feeling very happy about the current state of.
It's a melt. I mean, that's basically a meltdown, isn't it?
Well, it is. It just makes me wonder why the current situation number is actually coming ahead at 65.7. There seems to be a disconnect there against the forecast of 64.3. But yeah, it is. It's a real concern about what's going to happen in the second half of the year, or the last portion of this quarter and the next quarter on. Okay, and then in Italy. Normalised CPI for July, the month-on-month number, and another perplexing read down 2%. So deflation is alive and well in Italy, and that surely should be of a concern to the ECB. The forecast was, to be fair, for minus 1.9, so it's not a wild deviation from that. And the prior number was minus 2% as well. I know the ECB prefers to look at different measures of inflation, but to me that's
not surprising. Why?
Well, exactly. Just strike it. If we don't like one number, we'll create our own. But that rings alarm bells for me, and I think they must be concerned that QE isn't having the effect that they wanted it to.
Okay. Well, obviously it's not big enough. That's probably the message there.
Well, possibly.
Right. Let's go on to the European movers.
Okay, well, I mean, the China story really has dominated today. So the first stock that we'll look at is Daimler. That's ticker DAI in Germany. €80.52, down about 4.26%. And the reason, well, simply this, that the China devaluation makes it harder for German auto manufacturers to sell their cars.
Instant 2% price hike.
Yeah, absolutely, yep. But perhaps more importantly than that, the market, as you say, has voted with its feet, and it tends to believe that this action points to a softening Chinese economy.
So basically today was just like a bad day for Germany all round.
Absolutely, yeah. Poor ZEW numbers and bad news as far as their export-led economy is concerned. Not much better over the border in France, where we look at LVMH, Louis Vuitton, Moet Hennessy. That's ticker MC in Paris. They are trading around €168.20, down 3.5%. And why? Well, simply this. LVMH generates 29% of its revenues in Asia ex-Japan. I think really for that you can think China and Hong Kong for the large part of it, and that is its largest market. So again, big concern about the health of the rich Chinese consumer going forward, I think.
So really the Chinese have given the bears quite a decent helping hand.
They have, but to be fair, if you take a step back, I think the market's taken it, but this sort of knock on the chin pretty well. It remains to be seen how it would react to further bad news, for instance.
Okay, well let's go on to the next segment, which is the M&A side.
Okay, well it's more of a reorganisation than M&A, but Google has announced today that it's going to reorganise itself into a holding company structure, splitting itself effectively into two divisions. There will be Google and a new vehicle called Alphabet. Google will retain the core advertising, the search and Android and Chrome products, and Alphabet, anything that's considered non-core or to do with capital and funding. The structure said to be modelled on that of Berkshire Hathaway, and the reason for that is and it's quite a sensible reason probably, is to make the total value of the group and its investments and their performance more visible to investors. Google, of course, is involved in many areas apart from search and advertising. It's involved in driverless cars, high-speed remote internet access, quantum computing and artificial intelligence research, and many other bits. What many in the market are saying is that this sort of tidier structure will perhaps open the way up for further acquisitions or disposals. Some people have even mentioned Twitter as a possible acquisition target. We'll see if there's any truth to that going forward. In terms of the management, Larry Page, one of the original founders of Google, will be CEO. of the company. Ruth Porat, she'll stay as the CFO of Alphabet. She's previously CFO of Google as a whole. And a chap called Sundar Pichai is promoted to CEO of Google from deputy CEO, so he's had a good day. The market likes what it's heard. They're up around 5.25% at $667. Royal Bank of Canada's got a note out today saying they've got a $750 price target in the old form. So quite an interesting move, and one I'm sure we'll be referring to as we go forward to the balance of 2015.
So we don't think it's a triumph of style over substance, then?
No, I think to be honest, you know, that there's potentially a lot of value inside Google, and this might make it easier for the market to judge that as well.
Okay, well, let's go on to the US data points.
Okay, not the best day as far as data points are concerned. We've got our old friend, the Red Book chain store sales, a weak read last time out, and the observation here is that that we're making a move really back to the late April lows of around 0.8%. If you don't get a decent number today above that, then well, it just seems surprising to me that it keeps coming in with lower reads and a more negative outlook. Yet the market seems to shrug this number off. So perhaps we should do the same. Then wholesale trade for June. This is again a month-on-month number. A forecast here for growth of 0.4% against the prior read of 0.8%. Again, this number's been declining. In this instance, it's been declining since June last year. That May 15 read of 0.8% was something of a surprise to the upside. So we're not expecting anything as exciting as that. And then productivity and costs. So something that's perhaps been missing from the US market really of late, productivity. The forecast here is for growth of 1.6% against the very disappointing prior read of minus 3.1%. So don't be too surprised if we see something out of kilter there. And then labour costs. The forecast here is for plus 0.5. The prior read came in at 6.7%. Now that was seasonally adjusted, so I don't think we can really be comparing apples and apples.
All over the place.
Well, yeah, perhaps again that's why some of these second line numbers are discounted to some extent from the market, but we'll see how they come in and what the market does.
Okay, let's just go on to the pre-market movers and levels.
Okay, well, the first pre-market stock is one that we've mentioned a few times in this segment. Our old friend Tube Mogul, that's TUBE in the US as a ticker. This is an online media and marketing company. They fell 14% in normal trade yesterday, but bounced back after hours to rally 26.4%. As Q2 numbers showed a sharp rise in revenues, and the company guided higher for Q3. Now, I think part of the reason that they fell so hard in hours was that they were downgraded. Nonetheless, that's a remarkable
Heart attack inducing type of price action.
Absolutely, you have to be very brave to be trading that one. And then another stock that we mentioned in passing, at least in the last couple of weeks, Kraft Heinz, that's KHC in the US, $77.50, recently merged. I think the merger only completed at the end of July. They were down 1.66% pre-market, and the reason being that the debut numbers, which they released yesterday, show a decline in sales at both Kraft and Heinz. The company also didn't offer any additional guidance, so it's a bit disappointing really, and you'd at least have expected the management to try and talk up the prospects, having only recently done the deal, but they didn't do that, so the market's decided to vote with its feet. Again, I think perhaps this might be one that could come under a bit of pressure this afternoon, given the China story and probably the wider emerging market story as a whole.
Right, okay, well, and the levels on the major markets?
Okay, well, as you said, Zach, the bears have had the upper hand today, and in FTSE now we're looking at 66.55 on the downside, plays 67.50 to the upside. For the DAX, we're back to 11,380, plays 11,430 on the upside. US markets rallied yesterday in the face of Mr. Buffett's M&A activities, but we're looking now at 20.85 to the downside in the S&P, plays 21.05 on the upside, although I don't know that the upside level is in any danger of being tested this afternoon. And the Dow, 17,455 is our downside level, which we need to break to move lower. Plays 17,640. You need to see a move above there if we're to make further gains. What has been interesting actually is that the China news has basically weakened the dollar on the day, or strengthened the hand of its trading peers. So euro dollar 109.85 now on the downside, plays 110.50 to the upside, and on all of these you'd think you'd fancy the upside could move sooner than downside. The antithesis of that, though, Aussie dollar, US dollar, where the Aussies are obviously much more dependent on China than even the US. So 72.98 now, the downside level in the Aussie, plays 73.46 to the upside. Dollar yen, fairly sanguine about the whole thing, to be honest. So 124.65 is our downside level. We still need to break 125.00 properly to the upside. We have tested above there intraday, but it hasn't been able to sustain that, so we'll leave the round number in place. And cable again strengthened nicely against the dollar today, so we're back to 155.50 on the downside, plays 156.16 to the upside, and again it's the upside level that looks likely to crack.
Right, so the China story, setting the cat amongst the pigeons on various currencies in various ways.
Yes, absolutely, yeah.
Well, Darren Sinden, market commentator at Admiral Markets, thanks for the Wall Street crossover show today, and we'll be back at the same time tomorrow.